Welcome to the Personal CFO. Today I want to talk about investing in an environment where the expected rate of return may be zero. The reason I want to talk about that is in one of my prior videos, I showed a slide with based on current valuations in the US market, that the expected rate of return over the next 5 years could very well be 0% rate of return. And I had a few clients that reached out to me and they said, I just want to make sure that I'm reading this right, and this is the chart. I just want to make sure that I'm reading this right, but does this mean that the expected rate of return in the market is 0% potentially? And I said, based on history and the current valuations, that's exactly what this means. So I want to talk about a few things. One, how do we get to an expected 0% rate of return? And then I want to talk about what are a few options that we have. Because obviously that's not our goal, is to earn 0% by putting our capital and our money to work. So what are our options? Okay, let's talk first about how do we get to a 0% expected rate of return in the market? How do we project that? So going back to this chart, this looks at a extended period of time and based on current valuation, so what you pay for a dollar in earnings. Historically, in the US stock market, investors have paid about 16% or a little higher than 16%, 16.5% per dollar in earnings. So 16.5 price to earnings ratio, which is just a fancy way of saying how much am I willing to pay for the future cash flows of this company. Well, as of the end of 2020, it's actually a little bit higher now, but as of the end of 2020, people were willing to pay 22% or more than 22 times price to earnings. So 16 versus 22. People are willing to pay more for the same dollar in earnings. And if we go back to one of my prior videos where I introduced the seesaw, well, price and expected return move in opposite directions. So in this case, as the price that we pay goes up, the expected rate of return in the future goes down. And based on where we are now with valuations, price has gone up to the point where our future expected return is not high. It's actually zero when looking at historical numbers. Okay, that's not our goal, 0%. What do we do? Well, we have three options. Number one is we could just say, I'm going to do nothing. This time it's different. Things are expensive, but, right, we're in a new world. Price doesn't matter, and I'm just going to stick with the current investment strategy, and I'm fine overpaying for my investments because I think this time is going to be different, and it'll get even more expensive. That's option one. Option two is you could say, this isn't a game I want to play anymore. I'm going to go to cash or bonds, which unfortunately, as you may know, cash and bonds are returning really close to 0% also. Not a great option. Option three is looking and saying, are there other opportunities to invest my capital and invest my dollars that give me a better chance of success by not overpaying for an asset? I want to focus on option three because option one is self-explanatory, stay where you are. Option two is you're also earning zero or close to it with cash and bonds. So option three, are there areas that we can invest where you're not overpaying for assets? The Cliff Notes is yes, and if you want to learn how, just keep watching. Okay, so when we talk about the US market, that's thousands of companies. That is a huge group of companies. And what I want to discuss is markets in markets. So when people say the market is up or down, that could really mean anything. So they're talking about well-known markets on the news. And what I want to break down is the overall US stock market. So that's, again, thousands of companies, and see, is everything overpriced or just certain areas? Okay. So when we look at just the broad US markets, you can see that historically, relative to where it normally is, it's pretty expensive. So it's above that midline. Let's break that down into growth companies and value companies, both large and small. Okay. Large and small growth companies, so where we're paying a little bit more, but we're expecting them to grow, are incredibly expensive. Now, it doesn't mean they're not going to grow. It just means that we are paying historically high percentages for that growth, which, as we know based on our seesaw, doesn't bode well for future long-term returns. Okay, well, what about larger and smaller value companies? Well, when we look at this market inside of the market, what we see is it's actually trading at a discount, or it's actually trading lower than its historical average. So again, below that midline is below its historical average. And if we bring that seesaw back and imagine it's flat, okay? An average rate of return in the market means we're paying an average price. and growth were substantially higher, so it's a lower expected rate of return. But what about value? What we see is we're paying a lower than average price for value. Well, what does that do for the seesaw? It actually increases our expected rate of return above normal, potentially. So, the reason this is important is when people talk about the market, that's a very broad term, and we are able to, as successful investors, know what we want to buy, right? And be able to control where our investments are going. And in this case, there are certain markets within markets that are really expensive and certain markets within markets that are not very expensive. So I hope this was helpful in helping you understand when we talk about a 0% rate of return for the broad market, that doesn't apply to all your investable assets. That doesn't apply to your capital if you can focus on what do I own, why do I own it, and what is the price that I'm paying. I hope you found this helpful. Thanks for investing your time at The Personal CFO.